Good evening, everyone, and a warm welcome to today's webinar on legacy planning and financial wellness, brought to you by Vayah Vikas in collaboration with Funds India Private Wealth. A very special welcome to those joining Vayah Vikas webinar for the first time. We are thrilled to have you with us and hope today's session provides a meaningful introduction to our work and community. We look forward to your participation in many more programs. Vaya Vikas is a registered trust dedicated to building and strengthening an ecosystem for seniors, empowering them to lead productive, engaged, and meaningful lives. Our community connects senior citizens through an online platform and offers a wide range of services, including health and wellness, legal support, financial guidance, and numerous engagement activities. At Vaya Vikas, we believe that informed financial decisions are essential for living the years ahead with clarity and assurance. Many families postpone discussions on wealth preservation, inheritance, and long term planning, often realizing later how much structure and clarity could have helped. Today's session is designed to provide that clarity. In this webinar, you will gain practical guidance on personal wealth preservation, family legacy planning, and steps to strengthen long term financial well being. We are pleased to welcome Mr. Chandrashekar Upadhyay as our speaker. Mr. Chandrashekar leads the investment advisory functions at Funds India Private Wealth and brings over 2 decades of experience across banking and financial services. His career spans leadership roles in prominent institutions, and his expertise cover the full range of wealth and banking solutions. He has also authored a book on economics for CA Foundation students, highlighting his commitment to simplifying finance for learners and investors alike. We are confident that today's session will help you approach your financial decisions with greater clarity, confidence, and foresight. Over to you, Mr. Chandrasekhar.
Thanks, Aswani, and so nice of you. And thanks a lot for nice introduction and kind words for me. I will directly take you through the entire presentation. But before, just one confirmation: the screen is visible to everyone, no?
Yes, sir.
So just I am taking it to the full screen. So is it okay now?
Yeah.
And it is moving.
Yes, sir.
Okay, thank you. Thank you, ma'am. Thank you so much. So, good evening, everyone. Good evening. And this is a great privilege for me to be part of one of the social cause where this entire NGO is doing that. So, it's a privilege for me. And thank you for inviting me for this. So, what we have done, we have kept this presentation very simple. And we have tried to basically take you through what are the practical challenges people are facing nowadays and how we can just hands on that and just recover from there. So this is being planned into 2 3 stages. Obviously we plan the financial wellness as well as the legacy planning into that. Now before that, just only a few minutes about the overview of our company. So we were founded in 2009, one of the first pioneer into digital platform, headquartered at Bangalore, and we have around 2.5 million of client base, 820 plus basically employees as of now. Our expertise mainly lies on the technology-based driven AI portfolios, automated investment and real-time analytics. At the same time, we are registered with CB as a investment advisor as well as MP approved distributor also. Just to highlight that, basically this company is now under a roof of Westbridge, so it is being completely owned by Westbridge, around 100% of that. While if you talk about our major three pillars for that is the innovation, insight, and integrity. Innovations basically we're trying to take you through that we always try to find out the things by thinking out of box. So that is comes the innovation into that. Insights, if you talk about, obviously, I'm sure that a lot of people would be knowing about the Westbridge Capital. They have been an investor. They have been pioneer in finding a lot of big organization in the country like Access, ICIC, Bajaj Finance. The company you name, you'll find they are the founder of that. In that way, a certain point of time, maybe now and in the past also. So insights, we have a great insights from their research capabilities also at the same time. On the integrity, that is very important. Just I want to share with each of you. that on the integrity side, we always being believe that we'll suggest a product to a customer which we can take it to our parents, because everybody agrees to a fact that we never do wrong to our parents. So that is the ethos we take it with us as an integrity part, that we'll recommend only those product to our customers which is being fair enough to our parents also. Now, just jumping to the major part, as I promised that we have made it very simple. Now, the retirement planning solution. So basically, if you see, there are three parts into that. Once anyone retires, no, the three things which always comes in the mind. First is the health security. So obviously, health security can be divided into two parts. One is about which is being covered by the health insurance, and second is that there could be some medical emergency which are not part of those health insurance. So whether do you think that you have enough fund for the medical emergency which is not covered under the health insurance? So that is about the health security. Second part, we are trying to tell you that whatever money you have accumulated during your service time, whether you have invested it wisely so that you are able to beat inflation or not. Otherwise, what will happen? Inflation will eat around your entire savings. So there is a separate slide I will try to present before you, that how important this second part is, that is the growth versus inflation. And third part is the legacy planning. So normally we make a big empire, we earn good amount of money, we create wealth, but we sometimes fails to pass on this to a hand of our next generation. So that is also very, very important in that context. So just I will take you first, I will try to make you the second pillar what I mentioned about, that is the growth versus inflation. So let me make it very simple. So I know that there are a lot of data points and you would be getting confused, but you just focus on the beginning corpus. So what I am assuming that you have been retired and you have accumulated 5 crores of a surplus with you. Now, this 5 crores is the only money which is lying with you, and by this only, you have to plan your maybe the health side, you have to plan your regular expenditure, you have to plan maybe your some holidays also outside India or maybe in India. So, all expenses has to be covered into this 5 crores. So, how we should invest this 5 crores so that our entire things is being taken care of, and we should be having some surplus in our hand also. Now, to understand this, first you understand that I have considered two options here. Normally, as a senior citizen, what we say, the best option we say that fixed deposit is the best option. We should do fixed deposit only because this is a safer option. Obviously, it's a safer, so people prefer to do that. But I will just try to translate it that how efficient that fixed deposits looks like. At the same time, I have given you second option that you go into a mutual funds. These mutual funds, what I have considered, these are not the complete mutual funds in equity. These mutual funds are of a kind of nature where certain portion goes into equity and certain goes into debt. So debt means more or less similar to fixed deposit, not the fixed deposit, but the kind of or nature of investment is like a fixed deposit only. So this equity, what I have considered as a hybrid mutual fund, those are the balance advantage fund. So don't get confused about the name and all, but I've simplified it that it invests into equity and debt both. So how they play, when the market goes up, they book profits in equity, and when the markets come down, they invest more into equity. So these are the safer side. So as these are safer, we can compare it with the fixed deposits. Now, what has happened? In this, I have taken our returns of last 10 years plus. Similarly, on the FD rates, whatever rates we are having currently. So that rates comes to 8% for FD. And here we have got average return of 10.3% in last 10 years plus. Now, what will happen? Now the taxation comes into picture. Now, on the hybrid mutual fund, there is a taxation, and that taxation is very low as compared to the fixed deposit. Because what happens? There are short term and long term taxation into mutual funds. So, here what we have considered that there is a taxation which is the long term taxation, and that is very less as compared to the fixed deposit where you have to pay 33% near to that as per the slab rate. So, post tax, what we have said in post tax, in hybrid mutual fund, you will get a return of around 9%. And when you reduce tax from a fixed deposits, it comes to 5.6%. This is simple up to this extent. Then we come to inflation. What is the inflation now? We are assuming that 6% might be nowadays we have seen an inflation of 2.6 also in a range of 2.6 to 3.6. But on an average, it's the 6% inflation. So what I'm trying to tell you that might be you are doing a fixed deposit, but there is one of the option which is the hybrid mutual fund, where the returns looks like better as compared to fixed deposits, and inflation is constant in both the situation. And then I've considered that you want a monthly cash flow of 2 lakh rupees every month. So if you want 2 lakh rupees every month, obviously this has to come from this 5 crore only. So that monthly cash flow is 2 lakh in both the situation. Then the total withdrawal you do into 25 years is around 12.67 crores in case of mutual fund and 9.87 crores in case of fixed deposits. And the last one, which is reflecting, that is the end corpus. So, end corpus, how I have calculated? I have calculated that if you invest 5 crores in the hybrid mutual fund and 5 crores in the fixed deposit, and if you withdraw 2 lakh rupees every month, then at the end of 25 years, you have withdrawn certain amount. After that, also in case of mutual fund, your corpus lies at 9.42 crores. And in case of fixed deposits, it's become negative. So this is being presented in this chart. So how this chart look like? There are two bars. One is the green box, other is the golden bar. So green bar is basically the mutual fund investment what you have done, and you are withdrawing that, and after that also you see the kind of mutual fund at the end of 25 years that is positive and that is near to 9 crore plus. This one. But if you invest into a fixed deposit with that rate of 8% also, see the golden bar. Slowly it has started eating your corpus. And after 21 years, you see it has become negative. So what it means that you have consumed your entire corpus of 5 crore with the 8% upside into that over a period of 21 years. So after 21 years, you are not lying with any money into that. So this tells you that you need to be wise while investing. Just by putting into the fixed deposits will not going to yield you what you are expecting of over the long run. In long run, it will eat your entire corpus because you see the inflation is around 6% into that. At the same time, similar type of investment you can opt out into the mutual funds, and that is the hybrid category. In hybrid, there are a lot of funds where the risks are very less. So you can select any of that. We have selected balance advantage. Maybe if you of you are little more conservative, you can select a lower exposure to equity funds like equity saving. Also, obviously, return would be little lesser as compared to that. But yes, it will be always effective. So this is a myth that doing a FD is the only investment for a senior citizen and only best option into senior citizen. That myth we are going to break it now. And I'm sure that by going through this chart, everybody who's understood that. So I'm going back to the previous page. Now you can understand it well that 5 crore rupees, if you have invested as a lump sum amount, monthly withdrawal 2 lakhs per month, at the end of 25 years, the mutual fund corpus lies at 9.42 crores, but fixed deposits become zero at the end of 24 years only. In both the calculation, what I have considered the day we have invested 5 crores. From there, 24 months, we are not withdrawing any amount. So that is constant for hybrid mutual fund also, and that is constant for fixed deposit also. That is the only assumption we have considered here. Now moving out to the next slide. Now what happens? Suppose here you decided of कि चलो ठीक है, now I will not do FD, I will do mutual fund. Now for doing a mutual fund, normally what people does, they go to some websites and do type there by in the AI world, typing that what are the top 5 best mutual fund. So just typing top 5 best mutual fund, whatever names comes to you, you put money into that. Now that myth also I am going to break you now, that is the way, that is the wrong way what we are doing into that. So I know that you would be so confused by going through so red and white columns here. Just you read the heading said that avoid chasing performance, past winners in equity mutual funds may not be the future winners. What it means, just you come to last column, this is 2019 and 2021, and after that you see after 3 years it's become 2020 to 24. What we are trying to say you that the fourth fund, this is the fourth fund of 2019 and 21 on the basis of performance, after 3 years the ranking becomes 126. So the fourth fund of 19 and 21, which is the fourth rank on the basis of return, the last column, it becomes basically the last column, if you see, it becomes a 126th rank. So the mistake what we do, that don't go by only seeing the returns or maybe the rankings through the social media. You should be having a good advisor with you, a person, a trustworthy person who is being basically associated for you for a longer period, and obviously they should stick to you for the next generation also, so that when you pass this entire wealth to the next generation, they should be a witness to that. So this is the next myth we are trying to just clarify you. While moving to the next slide, if you see, similar mistake we do once more. What we do? We say that whatever has happened, avoid chasing performance. Present winners, which are the number one funds today, may not be having the past winners also. So you see the number fourth rank, the last column, number fourth rank of 2022 and 24. The rank is 4. Today it is ranked 4. But 3 years back, this rank was 130. So if we would have gone to a social media or maybe to Google, and just we have gone through the advice of that, just seeing the returns, we would have done the mistake every time. And this is the mistake normally people does. So just by seeing the rank, seeing the returns, you don't invest because your risk appetite is different. Your goals are different. Obviously, the valuation in that different market is different. Maybe today, if you come to me and you ask me where I should invest in equity, I would say that you invest only into the large cap, maximum to mid cap, because small cap valuations are very high. So this advisor can only tell you this AI cannot tell you this point of time. So this is the next myth we try to clarify you and to break it out. Now another myth we'll try to clarify you. We always feel that if we have invested into equity market, if we have gone out of FD and came into hybrid funds or maybe in the equity funds, in that case, which fund we should select? Now for an example, in large cap category also, no, there are more than 50 schemes which you should select. In mid cap there is a similar situation. In small cap there is a similar situation. Now all this falls into few styles. So what is this style? This style is being basically being divided into 7 8 parts. One is the dividend yield stocks, which is being also a style. Another style is value, then quality, low volatility style, size style, momentum style, nifty 50 index style, then global style. So global means you invest the money into outside India. Now what I'm trying to tell you, don't see so many things. You see this value, the bottom, this value, what is being reflecting here in 2018, the value style has given you minus 26% return. But at the same time, if you see, the other few style has given you some positive return. Same value in 2019, you see, it has given you minus 14% return. Same style, you see, 2020, it has given you positive, but that is marginally return of 8%. So if you had been invested into one style, that is the value style, any of one style, obviously you had not made the money. So आपका portfolio कभी आपको returns नहीं दिया होता. So in this situation, what we are trying to tell you, see in 2021, 22, 23, value has given you fantastic returns. So what we say that this style works in some years and some years they don't work. So you should be having an advisor who can suggest you that which style is better for which year and where you should invest into. Now to simplify it, what we say, we have a framework at Funds India. That framework is known as 5 finger framework. So this framework take care of all style what I discussed just before this slide. And we say that we are here to help you to market this style in every year. So what we say, we have created a 5 finger framework where we say we will first framework is blend. Blend will take care of quality and other stuff into that. Global exposure it will be taken care of in point number 2. Point number 3, we say that will take care of value and contrarian. Point number 4 will take care of quality style, and point number 5 will take care of mid and small cap style. So all style which I mentioned before this slide would be taken care of in this slide, so that you don't have to worry that which of the style will work, which will not work. And considering that, we make a portfolio for our customer. And this schemes how it has performed in the bad times. So it gives you an idea if market fall, how these schemes perform in five finger. So in five finger, if market is being divided into two parts. This blue one reflects you the Nifty 50. So top 50 companies of Nifty, and second one says you Nifty 500, top 500 companies of Nifty. And this the light green is our five finger. So in 2010 and 2011, when the European debt crisis was there, so Nifty 500 fall by 31%. At the same time, Nifty 50 fall by 27%. But the style which we have brought here, the five finger strategy, if your money had been into that, it has fallen by only 18%. Similar example, you come to global stock market sell off. I am sure you guys, everyone remember that 2015 and 2016. At that time, you see the Nifty fall, Nifty 50 fall by 21%, Nifty 500 fall by 19%, and we fell by only 9%. Why I am showing this? The reason is that it's not about only in the good times. In the bad times also, the focus is to conserve your capital, to save your capital to the maximum extent, to save your basically ring fence the entire wealth, so that it should not fall more than what is happening in the market. So if the market is falling to a larger extent, this portfolio is not falling at the larger extent. Yes, there would be fall, but that is limited into that. And similar has happened to the COVID crisis. In COVID crisis, Nifty 50 as well as Nifty 500 fallen by 38%. This portfolio has fallen by only 28%. So this we discussed about the bad times in the market when that declines, how this five fingers shapes up. Now I will give you into the good times or maybe long-term returns what it has yielded. So January 2010, we designed this. As I mentioned in the beginning only, we came into existence in 2009. And in 2009, after that, we created this five finger. We have done a back testing on that. And since 2010, we have done this entire presentation. In 2010, if you have invested 1 crore into the market has made it to 6.2 crores in July 2025. But that 1 crore, if you have invested into five finger, that has yielded you 12 crores in the month of July 2025. You see the kind of blend we are preparing. As I mentioned you, five finger gives you a comfort that you don't have to worry about the market cycle. You don't have to worry about what is happening in which style. You don't have to worry about which category is performing, which is not performing, because we are there to safeguard that. We are there to help you to understand and make your portfolio align to that. And that is the five finger strategy does. There is a clear cut outperformance here. It's a double what a corpus is being created if you have invested into five finger instead of invested into other places. So the idea is that it gives you a lot of comfort and understanding point. To make it simpler, we have presented this slide in the better way instead of putting a lot of data points to make you understand how the five fingers look like. So we are there as a good advisor, so we can help you to time the things on the style side. The next part, basically I will come on the estate planning. As I mentioned you that we create wealth, but after creating wealth, how we should pass it to our next generation. I'm sure that nowadays, if you see in the entire country, we are aware about that. In case of any death happening to the primary person in the family, there is a succession certificate which is being required nowadays. It's not about only panchayat or anybody who's giving that certificate and the entire wealth is going passing on to the next generation. It is not happening in that way. So succession certificate is required in that case. At the same time, what happens as per the Hindu Succession Act, if the primary person goes and if he has wife and two kids, entire property would be distributed equally between three. But if you had a will where you mention that maybe if I go, then my 50% of the property should go to my wife and rest 50% could be divided between two kids, then it will happen accordingly. So you can design your entire thought process even if you are not there through your will. Similarly, in the case of businessman, they can create a trust into that. At the same time, what happens? Normally, we feel that if I put in nomination, my work is done. No. It doesn't works in that way. If you have anything non-financial assets, what will happen in that case? In case of non-financial asset, obviously a lot of stuff has been there into that. But if you have a will, obviously you save your stamp duty also in this case. So the idea is that you have put in a lot of effort, lot of time, a lot of energy to create your wealth. So passing it to next generation is very important. You should be focusing on the ways. There are a lot of ways we help on that part also. We have a strong team to help people on that side. I'm sure a lot of you have already made your will and everything, but I thought that I will take you through that because this is very important in that sense. Now, just coming to why we should invest into mutual funds or maybe hybrid category funds instead of fixed deposit. There was a reason we discussed that inflation is eating away your money, but at the same time, why equity will do well. So it is completely dependent on the economy. So if economy do well, obviously our markets are also going to do well. Now, if you see from 4 trillion to 30 trillion, so this is basically a thought process which is being there. So by 2020, 2047, India is projected to be at 30 trillion economy. And how it will happen? Obviously, there are a lot of factors which is being there into that. But at least we have seen this journey to some extent, and maybe in the next 2 decades, this is going to happen in that. Why it will happen for India? Because India is the fastest growing economy. So I've tried to put forward few pointers here, few ideas that what other economies are doing. You say we always talk about world, US and everything because they are the developed, they will not grow with this pace. Even in the China side also, China is also projected to grow at 4% only. So we are going to grow at 6.5%. And then today, basically, the policy, if you see, RBI said that we are going to grow at more than 7.5% at that point of time. So the idea is that in the worst case, also, we are going at 6 plus. And obviously, the thought process or aspiration I showed of 30 trillion is going to be achieved by that. So this is one of the basic, you can say, the strong point what we have, the growth we have. At the same time, if you see on the household side, if we are having basically on the household side 100 rupees, still 51 rupees is going to real estate. So this real estate, we say that we don't make much money other than the land, but still we put more money into the property. So property still takes away 51 rupees out of 100. And what is happening on equity? Only 5.8. So with allocating only 5.8, we are able to see this Sensex and Nifty around 70,000. So you imagine where it will go if it doubles out. So immense opportunity is there in India. At the same time, if you see euro area, it's only 12%. But you see in the developed economy, it ranges from 17 to 22%. So this gives a lot of comfort. So in that sense, that yes, by 2047, definitely we can touch 30 trillion. So these are the basically cushions to that, and obviously a point where we can give to our thought in that idea. So, how we can participate or get benefit of India's growth? There are two ways, two things we have to think on. Obviously, you have to own the best company of the country. At the same time, whatever profit growth is happening, so that profit growth should reflect into your wealth growth also. So these two things, if happens, obviously your wealth will also grow. But for these two things, you need to have a good advisor. I am saying again and again, if you don't have a good advisor, if you don't have the advisor who stick to your next generation, if you don't have an advisor who are unbiased, obviously this growth story cannot be becoming a part of our journey. So this is very important in that way. Why we should put money in equities? Again, one more interesting data point I thought that I will show to everyone. So there are 1 year, 3 year, 5 year, 10 year, 15 year, 20 year returns. So the this one is about the returns, and this one is the about of multiple of amount you made over a period. So there are around basically we have considered the five categories: Indian equities, US equities, gold, real estate, and debt. So we say that Indian equity over a period of 20 years has given you around 15% of returns. US equity around 14, gold has given 14.4. Why it is reflecting 14.4? Because if you see in last 1.5 year, the kind of rally we have seen into gold has pulled up this entire CAGR returns of 14.4. Real estate you see 8.7 and debt 7.6. Now just ask a question to ourselves. If real estate has given only 8.7% return in 20 years, still we are putting 51% there. Is it a wise and wise decision? The answer will come no, it's not a wise. We should put money where we can multiply our wealth, and that is obviously equity, maybe to some extent gold also, because it has given fantastic return. But as a asset allocation strategy, we cannot ignore debt, we cannot ignore real estate, we cannot ignore gold, we cannot ignore any asset class. So it's all depend on your age, your thought process, your goals, how you are being planned for your maybe immediate some payments which comes into that. So it's all depend on that, and then the asset allocation decides you where and how much money you should put into that. Similarly, this slide tells you the multiple, and it's a equity is a clear winner. We can see that the multiple is around more than 16 times over 20 years. At the same time, if you see real estate, multiple is only 5.3. So this gives you a lot of comfort that yes, if we are not allocating money to equity as per our appetite, as per our asset allocation, then we are missing something. While moving to what are the products we offer, that was only two, three products I mentioned to you, but we have a boutique of products. Obviously, we offer a mutual fund, that is the curated mutual fund portfolio, depending on the risk appetite and asset allocation of the customer. We also provide you the PMS expert driven portfolio manager tailored recommendations for our customer. AIF is one of the category where the minimum amount is 1 crore, that can be divided into two parts: cat 2, cat 3. So cat 3 is the listed, cat 2 is non-listed. At the same time, we provide you the demat also, direct equities you can buy through our platform. Immigration advisory services we provide, state planning we provide, international gift city solution also we provide to our customer. So basically the NR customer can take this advantage. The reason is that there is a basically tax holidays, so you don't have to pay tax on that. At the same time, resident customer can also participate here the way of the LRS scheme, and up to that limit which is being provided by RBI, we can take advantage of that. Similarly, on the loan side also, we help our customer. So why I'm showing this? The reason is that if you see, we are not a manufacturer. So to tell you that we don't manufacture any product, and the reason for that is that we want to be unbiased. We cannot be biased to anything, and if we manufacture any product, we become biased to a product. So any advice, any suggestion, any distribution of product we do, that is basically a unbiased one. At the same time, as I mentioned again and again, the advisor should help you for the next generation part also. So in our organization, we are very different from other. We don't have the retirement age. Even I am working here at the age of 45. You will find me here at the age of 90 also, if I am alive into that. So this organization don't have the retirement age, so that we can be with the customer for hand holding to next generation also. So that was the idea, to just bring this slide to you. And obviously biased advice always become very profitable for everyone. While there are some value added services also which we provide to our customer, on the state planning side, as I talked about, passing on the wealth to next generation, we help you on writing will, we help in formation of private family trust, we help for the corporate trust if offshore structures, tax advisory, gift city, and other things. On the immigration side also, we help like EB5 for US, Canada, UK, Portugal, Spain, Greece, Dubai, and so on. Other services, if you see, we help on the private equity funding, stake sale, IPO, transfer planning, merger acquisition, so on. As I mentioned about that, Westbridge has been investor for more than 150 companies in India. They are basically a player who has founded a lot of big companies, like I mentioned about Bajaj Finance, ICC Bank, SDFC Bank. So they have been the funded to that, and they have helped to companies to grow in that level. So basically, this is the idea that they also help us with their research and all, and they are good into the unlisted space. So we provide a lot of recommendation on that side also. So this was all about basically the company, the financial planning, state planning, and all.
Thank you very much, Mr. Chandrashekar, for an insightful and practical session on legacy planning and financial wellness. Your guidance on wealth preservation and long term financial security has provided our participants with valuable direction to make informed decisions for themselves and their families. We hope today's discussion empowers you to approach your financial planning with greater confidence, foresight, and peace of mind. At Vaya Vikas, we remain committed to bringing you expert led sessions that support your financial, legal, health, and overall well being. We encourage you to stay connected and participate in our upcoming programs. A very special thank you to all our participants for your active engagement today. We truly value your time and trust. Wishing you continued financial clarity and well being. Thank you.